Introduction. When real estate becomes a security. By this point in the course, you have seen how brokerage can scale from single-family homes to commercial properties and entire operating businesses. Syndication takes that idea one step further. Instead of one buyer and one seller, you now have a group of investors pooling money to acquire, manage, and eventually sell larger real estate projects that would be out of reach for most individuals. The moment you start pooling funds from passive investors who expect a profit based on someone else's efforts, you move out of pure real estate and directly into the world of securities. That means federal and state securities laws, registration requirements, licensing through FINRA, formal disclosure documents, and specific exemptions such as intrastate offerings and private placements. This section ties together real estate syndication basics with the national securities framework that grew out of the Great Depression, including the Securities Act of 1933, Rule 144, Section 11 liability, and the Direct Participation Program, DPP licenses. Real estate syndication, structure and benefits. A real estate syndication is an investment structure where two or more investors pool capital to buy, operate, and eventually sell real property for profit. At its core, syndication is simply the pooling of funds from numerous investors and channeling those funds into real estate projects that a single investor could not afford or manage on their own. There are two main categories of participants. The syndicator is the organizer and manager of the investment. This party, or team, finds the property, organizes the legal structure, arranges financing, oversees management, and makes the strategic decisions about when to refinance or sell. The syndicator contributes expertise and sweat equity, and often some capital, but their defining role is control and management. The investors contribute money to the pool, typically as passive limited partners or members. They rely on the syndicator's expertise and do not participate in day-to-day management. Their expectation is to receive income distributions during the hold period and a share of the profit at sale. Participants in a syndication can be individuals, corporations, partnerships, LLCs, or joint ventures. In practice, most syndications are structured as limited partnerships or manager-managed LLCs so that one party can operate as the general partner or manager, while the others remain passive investors with limited liability. The primary benefit of syndication is leverage of both capital and talent. Investors gain access to institutional-grade properties and professional management that would be beyond their individual financial and managerial capabilities. Potential financial benefits include periodic income, long-term appreciation, and passive loss deductions through depreciation allocations. The syndicator gains access to capital and scales their business without having to finance everything personally. When syndication becomes a security under federal law, many real estate syndications are treated as securities rather than pure real estate deals. The Federal Securities Act of 1933 defines a security broadly to include any stock, note, bond, debenture, certificate of interest, or participation in any profit-sharing agreement. The key idea is that a security represents either ownership or a claim on debt that has value and can be bought and sold for profit. Limited partnership interests and similar passive interests fall squarely into this definition because investors expect to make a profit from a common enterprise based primarily on the efforts of others. In a real estate syndication, the investors provide capital but have little or no direct control over marketing, management, or operations. They are relying on the syndicator. Because of that, their interests are treated as securities. Once an offering is classified as a security, it is no longer enough to hold a real estate license. The sale of those interests must comply with federal and state securities laws, including registration and licensing requirements. The Federal Securities Framework, 1933 and 1934 Acts. The modern securities regulatory system in the United States was born out of the stock market crash of 1929 and the Great Depression. In the 1920s, many companies issued stocks and bonds with little or no oversight, inflated earnings, and misleading financial statements. Investors bought what they thought were thriving companies, but were in fact failing enterprises. When the truth caught up with the hype, the market collapsed. Congress responded with a series of laws aimed at making securities markets more transparent and honest. The Securities Act of 1933 focuses on the initial offer and sale of securities. Its main purpose is truth in securities. Companies that wish to publicly sell securities that affect interstate commerce must register with the Securities and Exchange Commission, SEC, and provide full and fair disclosure of material information to investors. That disclosure is typically made through a registration statement and prospectus. The Act also requires that companies comply with the securities laws of each state where their securities are sold, regardless of where the company is physically located. If a company headquartered in New York sells securities to investors in Arizona and Michigan, it must follow both federal law and the securities laws of Arizona and Michigan. The Securities Exchange Act of 1934 adds regulation of secondary trading and established the SEC as the primary federal securities regulator. It governs broker-dealers, stock exchanges, and ongoing reporting obligations for public companies. The Maloney Act of 1938 amended the 1934 Act and allowed for industry self-regulation through national associations that register with the SEC. This led to the creation of the National Association of Securities Dealers, NASD. NASD later merged with the regulatory arm of the New York Stock Exchange to form today's Financial Industry Regulatory Authority, FINRA, the primary self-regulatory organization for broker-dealers. Today, anyone selling securities to the public must be registered with or associated with a registered broker-dealer, and that broker-dealer and its individuals must be licensed under FINRA rules. This includes real estate brokers who wish to sell syndication participations that qualify as securities, Rule 144, and restricted or controlled securities. Under the 1933 Act, securities sold to the public generally must be registered. However, there are limited exemptions. Rule 144 allows for the public resale of certain restricted and controlled securities without a full registration, as long as strict conditions are met. Restricted securities are typically those acquired in private, non-public offerings. Controlled securities are owned by affiliates of the issuing company, such as officers, directors, or large shareholders. Rule 144 places limits on the amount, manner, and timing of resales to prevent insiders from flooding the market or evading registration requirements. For example, one condition might limit the amount sold in a 3-month period to a small fraction of total shares or a specific dollar threshold. While the detailed thresholds and holding periods are a securities specialist domain, the key takeaway for a real estate professional is that whenever you are dealing with privately issued or insider-held interests in a syndication or RET, you are in the world of restricted or controlled securities and must stay within the Rule 144 and related guidance. Section 11. Liability. Consequences for misleading disclosure. A disclosure-based system only works if there are real consequences for lying or omitting material facts. Section 11 of the Securities Act of 1933 provides those consequences. Section 11 states that if a registration statement contains an untrue statement of a material fact or omits a material fact required to make the statements not misleading, the issuer and certain related parties, such as directors, underwriters, and signers, can be held liable to any person who acquired the security. The wronged investor does not have to prove fraudulent intent. They only need to show that they bought the security and that the registration statement was materially false or misleading. If successful, they can recover damages equal to the difference between the price paid and the value at the time of the lawsuit, applied to real estate syndications. This means that if the prospectus or offering memorandum overstates income, understates expenses, hides major risks, or otherwise misleads investors, the syndicator and related parties may face serious civil liability. Full, accurate, and balanced disclosure is not just good practice, it is a legal requirement. Direct Participation Program, DPP, licenses. Because real estate syndications and similar pooled investments are often structured as direct participation programs, where investors receive a direct interest in the program's results, FINRA created specific limited licenses to regulate professionals who sell them. In 1980, NASD, now part of FINRA, created the Direct Participation Program license. There are two primary levels. The DPP Limited Principal License, commonly known as the Series 39 license, is for principals who supervise or manage the sale of these programs. The DPP Limited Representative License, commonly known as the Series 22 license, is for salespersons who directly sell DPP interests to investors. Both licenses require passing a FINRA examination and filing the appropriate applications. A real estate broker who wants to legally sell limited partnership interests or similar securities in a syndication must be associated with a broker-dealer and hold the appropriate FINRA license or work with someone who does. Prospectus and securities registration for syndications. Real estate syndications that constitute securities offerings are subject to strict SEC disclosure requirements. The primary disclosure document is the prospectus, also called a private placement memorandum in some exempt offerings. The prospectus is a comprehensive narrative and data summary of the investment, the property, the business plan, projected income and expenses, sponsor experience, fees, risks, financing terms, exit strategies, and tax considerations. It must present material information in a balanced way, not just the upside. A key feature is an explicit risk disclosure section that warns investors about uncertainties, vacancies, market shifts, interest rate changes, loss of key tenants, sponsor risk, and more. Some syndications must go through full registration with the SEC. Full-scale registration involves filing a detailed registration statement and having it reviewed and declared effective by the SEC. This process is expensive and time-consuming. So many real estate syndications instead rely on exemptions that allow them to avoid full registration while still complying with disclosure obligations. Exemptions. Intrastate and private offering securities law recognizes that not every offering should be subject to full federal registration. Two important exemption categories for real estate syndications are intrastate offerings and private offerings. An intrastate exemption applies when the issuer, the property, and all investors are located within a single state, and the issuer is doing most of its business in that state. The logic is that genuinely local financing of local projects can be left primarily to state regulation. The SEC's Rule 147 provides a safe harbor framework for intrastate offerings. To qualify, several conditions must be met, including the issuer is incorporated, organized, or, if an individual, has their principal residence in the state where the offering is made. The issuer derives at least 80% of its gross revenues from that state over specified periods. At least 80% of the issuer's assets are located in that state. At least 80% of the net proceeds will be used in that state. The issuer's principal office is located in that state. Offers and sales are made only to residents of that state, and resales are restricted to state residents for a defined 9-month period. The securities carry legends and transfer restrictions, and purchasers provide written representations of residency and receive written disclosure of resale limits. Meeting all of these conditions places the offering inside the Rule 147 safe harbor. Failing one condition does not automatically destroy the exemption. but it removes the certainty of safe harbor and increases risk. A private offering exemption applies where the syndication is limited to a small number of investors. For example, 35 or fewer non-accredited investors under certain rules, and is not offered through general advertising or public solicitation. Even when exempt from registration, the issuer must still provide a disclosure document that functions much like a prospectus. Exempt from registration never means exempt from disclosure or honesty. Regardless of exemption, a syndicator must provide investors with clear, written disclosure of material facts and risks. State blue sky regulation. On top of federal law, every state has its own securities statutes, often called blue sky laws, along with state securities regulators. These laws govern licensing, registration, or notice filings, and enforcement within the state. In general, states recognize FINRA licensing and self-regulation for broker-dealers and registered representatives. However, real estate licensees who want to participate in syndications cannot ignore state securities requirements. You must know or work with counsel who knows how your state treats private offerings, intrastate offerings, notice filings, and permissible advertising. If you are a real estate professional in Arizona, for example, it is not enough to know the ADRE rules and the real estate code. If you intend to raise money for a pooled real estate venture, you must also be aware of Arizona's securities laws and coordinate with the Arizona Corporation Commission's Securities Division and Qualified Securities Council. Securities brokerage firms versus real estate syndication sales. To tie this back to earlier parts of the chapter, remember that brokerage is simply the business of bringing together buyers and sellers of an asset. Whether that asset is a house, a shopping center, a business, or a share of stock. Securities brokerage firms act as intermediaries between investors and the financial markets, helping clients buy and sell stocks, bonds, mutual funds, and other securities. Full-service brokerage firms offer trade execution plus extensive advisory services, financial planning, portfolio management, trust services, and more. Their fees and commissions are higher because they provide personalized advice and ongoing relationship management. Discount brokerage firms focus on trade execution at lower cost and traditionally do not provide personalized financial planning. Modern discount firms provide powerful research tools and education, but expect the investor to make their own decisions. Online brokerage firms deliver services primarily through internet platforms or smartphone apps. Many are part of larger full-service or discount firms, but some are fully online. In these accounts, clients enter their own orders and use the platform's research tools without direct access to a personal advisor, in exchange for very low or even zero trade commissions. For a real estate professional, the important point is that selling shares in a real estate syndication is closer to what a securities broker does than to a traditional property sale. When you cross that line, you must respect the securities licensing, disclosure, and compliance framework just as a stockbroker would. Review summary. In this section, you learn that real estate syndication is the pooling of investor capital under the management of a syndicator to acquire, operate, and eventually sell real estate projects that would be beyond most individuals' reach. Syndication interests are usually securities because passive investors expect profits based on the efforts of others, which brings the investment squarely under federal and state securities regulation. You examined how the Great Depression and widespread securities fraud led to the Securities Act of 1933 and the Securities Exchange Act of 1934, which require registration, disclosure, and ongoing regulation of both issuers and broker-dealers. You saw how Rule 144 creates a pathway for reselling restricted and controlled securities, and how Section 11 places liability on issuers and related parties for materially false or misleading registration statements. You explored direct participation program licenses, Series 22 and Series 39, created by FINRA for those selling real estate syndications and similar programs, and how a real estate broker must coordinate with a properly licensed broker-dealer to sell those interests. You learn that syndications must provide a detailed prospectus or offering memorandum and may require full SEC registration unless they qualify for exemptions such as intrastate or private offerings. You also review the specifics of the intrastate exemption under Rule 147, including the 80% test for revenues, assets, and use of proceeds, residency, and resale restrictions, and required legends and purchaser representations. Finally, you connected these ideas to state blue sky laws and to the broader world of securities brokerage firms, recognizing that once you raise money from passive investors, you operate in a dual real estate and securities environment. Discussion with answers. Why is a limited partnership interest in a real estate syndication usually treated as a security rather than a simple real estate interest? Answer: because investors contribute money to a common enterprise and expect profits to come primarily from the efforts of the syndicator, not from their own active management. They are passive participants relying on someone else's expertise, which falls squarely under the federal definition of a security. How did the experience of the Great Depression shape the modern regulation of real estate syndications and other securities? Answer: the crash revealed widespread misrepresentation and lack of disclosure in securities markets. Congress responded with the 1933 and 1934 Acts, creating mandatory registration, disclosure through prospectuses, the SEC as a regulator, and later self-regulation through NASD/FINRA. These same rules apply to modern real estate syndications because they are securities offerings. What role does a prospectus or offering memorandum play in a syndication? And how does Section 11 influence how it is prepared? Answer: the prospectus is the primary disclosure document, providing investors with a complete and balanced picture of the investment, including risks. Section 11 makes issuers and related parties liable for materially false or misleading statements. This pushes syndicators to be accurate, conservative, and transparent rather than promotional or incomplete. Why should a real estate broker be cautious about raising investor money for a pooled deal without consulting securities counsel or a licensed broker-dealer? Answer: because the moment the offering qualifies as a security, the broker may be engaging in unlicensed securities activity if they lack the appropriate FINRA licenses and disclosures. This can lead to regulatory enforcement, civil liability, and even criminal exposure, regardless of their good intentions on the real estate side. Closing remarks. Syndication and securities brokerage are where real estate practice intersects with Wall Street rules. As real estate values and projects grow larger and more complex, you will see more investors, more pooling of capital, and more structures that qualify as securities. If you understand when you have crossed that line and respect the framework built by the 1933 and 1934 Acts, FINRA, and state regulators, you can participate in these opportunities safely and ethically. Your job as a real estate professional is not to become a securities lawyer or investment banker, but to recognize when specialized securities rules apply, to disclose honestly, and to bring the right professionals to the table. Done correctly, syndication can be a powerful tool to expand what you and your clients can accomplish in real estate without ever losing sight of the legal and ethical guardrails that protect investors and the market as a whole.